talk money.
Welcome back. You're with us on Let's Talk Money. And this week we are discussing factor-based investing, what is also known as smart beta investing. So all of our viewers are extremely smart, and I'm sure they want that extra edge into their mutual fund portfolio. So that's the question, gentlemen. Now that we've understood the concept, the point is that in your mutual fund portfolio, which anyway has lots of diversified mutual funds, and I think a lot of people have understood that you need to have a basic index fund, like a Nifty fund maybe. How do you add this whole factor-based approach, Pradeep? And to what extent, 10%, 5%, 20%, right. How should you design the portfolio then using these?
Yeah, so to blend into a portfolio is always a tricky question. So you need to think about it slightly differently. So if somebody is positive about India as a story, right? If you're saying that India is a growth story, I'm going to be invested in it for a long period of time. Factor investing gives a very different and alternative way of looking at that growth story and participating in it at a much more lower cost compared to a typical active fund. And at the same time, it gives you the benefit of a systematic rule-based approach, which will kind of reduce your risk at the same time. So on a risk-adjusted basis over a long period of time, if someone is looking at a decent return, then factor investing definitely comes into play. And there, again, the question of how much is a very tricky question. So one way of looking at it is, if you're looking at a multi-factor model, for example, it can be a very good substitute for a pure breed index fund in a large cap index or a mid cap index or a small cap index, because what it does is it has a similar kind of rigor when it comes to looking at the key ingredients that go into successful investing, but at the same time it tries to create a bit of an alpha over and above the index.
Yeah, so I think this is taking our investing journey and experience to the next level, right? 2.0 or 3.0, that instead of just a plain vanilla Nifty 50 fund, you might want to select something where you have the Nifty 50 stocks, but there's an additional filter of, say, quality or maybe alpha, higher growth, so on and so forth. On the point of cost, Pradeep, that was a really important point for all our viewers as well. Sure. Typically, many of these multi-factor funds, if they are just based on the indices, they would be low in cost. But you mentioned that there are some blended strategies where there could be some element of active fund management as well. Yes. Are there a lot of such examples? And, is the cost substantially higher, lower, comparable to diversified funds?
Not too many examples at this stage, but we would expect more such funds to come in the times to come. But then in terms of cost, that should still be lower than an actively managed fund. Most of the smart beta strategies should be somewhere in between passive and active when it comes to cost as well.
Okay, there you go. So, an edge to your portfolio with the perhaps lower costs as well. So that sounds really good. Now we come to the tough part, Harshvardhan. Now you tell us which are the strategies that make sense to you right now, why, what are you convinced about, and what would you recommend?
So, Surabhi, let's understand in layman terms, what am I trying to do? And what am I getting in return of that? How much additional risk am I taking? That's the equation that you're trying to balance. Okay, so say, for example, I am saying that I have an option to invest into Nifty 50, which is an index fund, which cost me, say, 0.3% as a fee. My returns are going to be in line with market. If the markets go up, that's the maximum I'm going to make, whatever the market has given. And if it falls, I'm going to lose as much as the market has lost. Now, what I'm trying to do is, I'm saying that, look, I'm not happy with this, or rather, I want something more. So I say that, look, let me put some filter into this to say that Nifty 50, value 20.
Okay.
Okay, so I say I want to invest in only 20 companies. In terms of valuations, etc., they're more favorable, so that in case there is any kind of a downturn, I will fall lesser than the Nifty 50 now. And in case the markets go up, the value unlocking happens, I will make more money than the Nifty makes. That's my intent. Okay. Okay. So first I'm going to calculate is what is the additional cost am I paying for this? So obviously it's going to be a little more expensive in terms of fund management cost over and above the Nifty 50.
Sure.
The next element I'm going to see is that how much additional risk am I taking? Because there is going to be more risk. If Nifty 50 has, say, X risk, and I'm boiling it down to 20 companies out of that, I'm going to have more risk. So if I'm taking additional risk, what is the additional gains am I making?
Sure.
All you may take more risk, but the returns are the same.
So risk-adjusted returns.
So risk-adjusted returns. So you have to evaluate that. Then you come to the segmentation, like the size of the company. So suppose now we looked at Nifty 50, then you have Nifty 100, then you have Nifty 200, then you have Nifty 500.
Right.
So what is the universe of selection that you want to pick?
Yeah.
So it has to be 100 companies, top 100, 200, 300. So that again will be your parameter, individual parameter. You sit down with your financial advisor and you say that, this is what we are going to be looking at, the universe of investments.
Sure.
Then you pick the strategy.
Right.
Now, which could be alpha, could be low volatility, could be momentum, could be quality, value. It could be
whatever suits your own personal objective and style.
Correct. So, in my personal opinion, now I like 4 factors. Okay, very clearly. So, one, I like the equal weight. I like equal weight. Why? Because as I mentioned, that I have equal exposure to all the companies of the Nifty 50, etc.
Yeah.
The other I like is alpha combined with low volatility.
Okay, so alpha will capture stocks that are likely to do better than the index.
And they're less volatile.
And they're less volatile.
So
Sounds fantastic.
That's an ideal situation, right?
Yeah.
And the universe of stocks to pick is top 300 companies. So I have large cap, mid cap, small cap. The entire universe has been picked up. So Nifty Alpha would have a, the universe of companies would be, say, large, mid, and small. It goes across all.
Okay.
So if I have a strategy where I have alpha with low volatility, and if my risk-adjusted return is obviously much better, I mean, why not? And I'm paying a cost which is lesser than an active fund, but little higher than a passive fund. So I think that works very well. Value, of course, over a long term, you need to buy something at a right valuation. You may find a very good company, but if you're paying a high price for it, your profit, you coming into profitability will take longer.
Okay, so name, finally, as we're wrapping up, name some funds, some strategies, and not specific recommendations, but where you like the product and which are offering these combinations that you just
So
said.
one is, of course, Nifty equal weight. I just mentioned, I gave you the example of how the allocations are different.
Yes.
I like the Nifty Alpha low volatility 30. I believe that's the strategy that you have. You have value, of course. I mean, as simple as that. A Nifty 50 value 20 could be. You have momentum. We spoke about momentum. Momentum, specifically if you have a structurally positive outlook on the market.
Sure.
So only if you are very clear that, okay, there could be volatility in the short term, but I'm positive on the structural growth of the economy and the market. So India is in that phase right now. So you would want to play the momentum strategy. So, so we spoke about it the last time on the small cap side, right? So in the small cap, my personal belief is that it's a 250 universe, the small cap index. I don't think it would be wise for a aggressive investor or a well-heeled investor to invest in the entire basket of 250 because the small cap space, it's about stock selection. So you could use a filter which is momentum and quality. Okay, in the small cap side. So it will be Nifty small cap 250, momentum quality 100 fund kind of a thing.
I remember this. Yes, I remember this, which is why it came to my mind that we should do a complete breakup, a full classroom on multi-factor funds. Before we sign out, Pradeep, final word, things to avoid, mistakes to avoid, and things to keep in mind while you're going about, trying your hand with these smart beta strategies.
Sure. Any smart beta strategy should be assessed on who is offering you that, how well is their model, how long has it been back tested, how robust is it, and how has it performed across market cycle. With that, then you will have a good enough information to kind of tip your toes.
Okay. All right, gentlemen. Thank you very much. Very, very interesting subject at hand, and something I think going sort of forward, we will hear more product innovation and perhaps more interest from investors as well. Thank you for taking us through this one. But with that, we are completely out of time. It's a wrap on this edition of Let's Talk Money. Thank you for watching. Keep sending us your feedback, comments, and queries. See you again next week.
Let's Talk Money